Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. Tuesday, April 28, 2026. Wall Street hit the brakes. Not a panic day, more like a quiet bleed at the index level with a much heavier feel underneath. Big headline theme: AI and semiconductors took the hit while defensives and energy caught real bids. Oil strength mattered and the tone shifted toward cash flow certainty, not high beta growth. On the S&P 500 Heatmap, this was a split-screen session. Bright green in defensives, staples, utilities, healthcare, plus energy, and then a concentrated red zone in semiconductors and hardware. Here's the tell: the index looked calmer than the average trader's P&L, because the pain was clustered where positioning was crowded, especially in the chip complex. That Heatmap split came from one clean flow. Money rotated out of the crowded AI and chip trade, and into what traders could explain in one sentence: steady demand, pricing power, dividends, plus oil-levered cash flows. Small caps felt it too, underperforming in a de-risking tape. This wasn't sell everything, it was sell beta, buy certainty. Here's the tension that drove the day. AI Capex euphoria versus the market asking bluntly, who's paying and what the payoff really looks like? That question showed up in the supply chain. Semi-equipment took the brunt, which is why the move felt more structural than a one-off headline. But the market didn't unravel. Big, high-quality megacaps kept the index optics orderly, a classic generals up, troops down session. One chatter thread really set the early tone: growth spend anxiety tied to OpenAI headlines. The market traded it like a Capex durability story across AI infrastructure. But this is exactly the kind of narrative that can be headline-driven and prone to overreaction. So label it correctly: not a proven fundamental break in one day, but a story that clearly shaped positioning and price action today. Nvidia fell about 1.5%, and even though that move looked contained, it mattered because it's still the primary sentiment proxy for the AI trade. But today's selling wasn't just about one megacap. The deeper stress showed up underneath, especially in semi-equipment, which made the AI tape feel a lot heavier than Nvidia alone would suggest. Applied materials dropped almost 6%, and this is where the session's message got a lot louder. Equipment is the real economy side of chip Capex. When the tool chain gets hit this hard, the market's telling you it's repricing Capex duration exposure, not just trimming a frothy AI headline stock. Oracle slid just over 4%. Same catalyst in the tape, that AI growth spend anxiety, and Oracle traded like an AI infrastructure beneficiary, where that story really matters. Takeaway? The market wasn't only hitting chips. It was also leaning on parts of the ecosystem tied to infrastructure commitments and return on investment expectations. Coca-Cola jumped almost 4% after Q1 2026 earnings, with earnings per share and comparable earnings per share both up. But the bigger point is what it signaled in context. The defensive bid was so strong that Coca-Cola actually traded like a momentum stock. That's a loud tell that institutions were paying up for perceived earnings certainty, while higher beta tech was getting de-risked. Microsoft gained just over 1% as money leaned into mega-cap quality. And there's a clear calendar reason it stayed center stage. Microsoft reports earnings after the close on Wednesday, April 29th. Given today's AI Capex anxiety, Microsoft becomes a major checkpoint for how the market thinks about monetization, margins, and Capex accountability, without assuming any outcome. Apple was up a bit more than 1%, and it played a very specific role today: index ballast. This was that generals up, troops down dynamic again. Apple's participation helped keep the overall tape orderly, even while semiconductors and the AI toolchain were taking real damage. Looking ahead, the next near-term catalyst is Microsoft earnings after the close on Wednesday, April 29th. At the same time, energy leadership stays sensitive to Strait of Hormuz headlines. That's a headline-driven volatility risk for oil and for the broader rotation. On next week's macro calendar, ISM services, PMI and JOLTS on Tuesday, ADP on Wednesday, weekly jobless claims on Thursday, then Friday's jobs report, with wages, and University of Michigan sentiment and inflation expectations. Positioning question is simple: does AI stabilize, or do defensives keep leading? Clean wrap on the day, rotation, not market-wide liquidation. Key stress point was the semi-equipment complex. Key support came from defensives and energy. Into the next session, watch whether the troops in chips can actually stabilize and whether megacap support holds with earnings and oil headlines setting the tone. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.